global reckoning. It is April 2026, and the global markets are currently navigating a high volatility minefield that most investors didn't see coming. For years, the play was simple: buy US mega cap tech and wait. But as of this month, that strategy is officially bleeding. Geopolitical tensions in the Middle East have escalated into what analysts are calling the Iran overhang, a cloud of uncertainty that is stifling risk appetite across the Western Hemisphere. While the media focuses on the red tickers in New York, a massive regime shift is happening under the surface. We are witnessing a broad risk-off correction that is punishing concentration and rewarding diversification. After a blistering start to 2026, March has become the month of the Great Rotation. Investors are no longer asking if they should move their money, but where. From the surging Nikkei in Tokyo to the commodity-heavy London Stock Exchange, the map of global wealth is being redrawn in real time. If you are still holding a 2025 portfolio, you are likely watching your year-to-date gains evaporate. Today, we break down exactly why the US is cooling down and which international exchanges are becoming the new safe havens for 2026. USA, the end of Magnificent Seven dominance. Let's look at the numbers coming out of the NYSE and Nasdaq, and quite frankly, they are sobering. The US market is entering a painful cool-down phase after hitting euphoric all-time highs back in January. The S&P 500 and the Nasdaq 100 are currently struggling, down roughly 3 to 4% year-to-date. But the real story isn't just the index price, it's the internal decay. The former Magnificent Seven, the titans that carried the market through the AI hype of 24 and 25, are facing intense selling pressure. Investors are rotating toward value as tech valuations hit a mathematical ceiling. However, there is a silver lining for those looking at small caps. In a major regime shift, the Russell 2000 has actually outpaced large caps, surging 6 to 8% as of mid-March. This tells us that the smart money is moving away from over-leveraged tech and into domestic, industrial growth. The current headwinds are undeniable. Stagflation fears are rising, and the S&P 500 recently breached its critical 200-day moving average. This technical breakdown is a massive sell signal for algorithmic traders, suggesting that the US cool-down might last longer than just a few weeks. You need to be looking at the 200-day line as your line in the sand. UK, the commodity fortress of 2026. While Wall Street is shivering, the London Stock Exchange is having its best year in a decade. The FTSE 100 has emerged as a standout global performer in 2026, returning nearly 10% year-to-date. For years, the UK market was criticized for being heavy on old-world industries like energy and mining, lacking the flashy tech growth of California. But in the high inflation, high-conflict environment of March 2026, those old-world stocks are the ultimate defense. Thanks to the ongoing Middle East conflict, Brent crude oil is now trading comfortably above $100 per barrel. This has sent shares of BP, Shell, and Glencore into a vertical climb. Investors are effectively using the UK market as a hedge against the high valuations and geopolitical sensitivity of US tech. It's a classic defensive play. When the world gets volatile, you move into tangible assets and energy. The FTSE 100 isn't just a stock index right now, it's a commodity warehouse. If the Iran overhang persists, we expect the UK to continue outperforming as a safe harbor for capital fleeing the Nasdaq. The yield play here is also becoming too attractive to ignore, with UK dividends far outpacing the shrinking yields of US growth stocks. This is Treadworn Journeys. Hit the subscribe button to stay informed. Europe, financials and the strengthening euro. Moving into mainland Europe, the MSCI Europe Index is showing surprising resilience, currently up approximately 7.3% on the year. The narrative here is a cyclical recovery driven by a higher-for-longer interest rate environment. European banks and financial services are leading the charge, finally seeing the net interest margins they've dreamed of for 15 years. We're also seeing a significant pickup in mergers and acquisitions activity across the DAX and CAC 40, as companies use their post-pandemic cash piles to consolidate power. However, it's not all smooth sailing. There is a brewing currency impact that every international trader needs to watch. The euro is currently strengthening, with forecasts pointing toward a $1.25 level against the dollar. While a strong euro makes the European market incredibly attractive for US-based investors looking for currency gains, it is starting to act as a drag on large international exporters in Germany and France. If you are buying European stocks today, you are making a bet on the banking sector and the euro's purchasing power. It is a sophisticated play that requires balancing the cyclical strength of the financial sector against the potential headwinds for the industrial exporters who find their goods becoming more expensive on the global stage. Japan, the era of Sanaenomics and 58,000. If the UK is the fortress, Japan is the golden child of 2026. The Nikkei 225 has been nothing short of explosive, surging nearly 17% year to date. The index recently shattered records by crossing the 58,000 mark, fueled by a perfect storm of corporate reform and politics. We are now firmly in the era of Sanaenomics, the fiscal expansion policies under Prime Minister Sanae. These policies have combined aggressive government spending with corporate governance reforms that force companies to return value to shareholders. This is exactly what foreign investors have been waiting for. Even with hints that the Bank of Japan might finally move away from its historic ultra-low interest rates, foreign inflows remain at record-breaking levels. The yen's continued weakness has been a massive tailwind for giants like Toyota and Sony, boosting export profits to levels that were unthinkable 5 years ago. Japan is currently the only major market where growth, policy, and value are all aligned. The 58,000 level on the Nikkei was once thought to be a psychological barrier, but it has now become a floor. For the first time in nearly 4 decades, Japan isn't just a value trap, it's the primary engine of global equity growth. Summary: the Great Breadth versus Concentration War. As we wrap up this global tour, the theme for the rest of 2026 is crystal clear. It is a war of breadth versus concentration. The AI hype that carried the markets through 2024 and 2025 has officially hit a valuation ceiling in the United States. We are seeing a healthy, albeit painful, deflation of the tech bubble as investors realize that 100x multiples are unsustainable in a world of $100 oil and geopolitical instability. But as we've seen, the money isn't leaving the stock market, it's just changing zip codes. International markets like Japan and the UK, along with US small caps, are finally catching up after years of underperformance. This catch-up trade is where the real money will be made in the second half of the year. Your strategy needs to adapt. If you are over-concentrated in the Magnificent Seven, you are fighting a losing battle against the current macro trend. The successful 2026 investor is looking at Sanaenomics in Japan, the commodity strength in London, and the financial recovery in Europe. The world is moving toward a more balanced, diversified growth model. The question is your portfolio ready for a world where the US isn't the only game in town? Let me know in the comments where you're moving your capital this month. Community tab post. Poll question: with US tech cooling off in April, where is your safe haven for Q2 2026? Channel memberships are now available. Watch for the weekly videos dropping on Mondays and Thursdays. Leave a message in the comments. Like and share.
This is the stock market performance playlist, the sound of victory. Peace.